Federal Reserve Chairman Jay Powell was in front of Congress today, and for a change, as he spoke, the markets actually rose higher and higher. A lot of times it's the opposite. So that was good to see. Bulls were out and running in force today. In fact, the NASDAQ composite hit a new all-time high. We were very close on the S&P 500, as it sounds like he still believes the inflationary pressures will be transitory and is not expecting to raise interest rates too soon. And so the market seemed to perceive that information quite well. But it's not quite as strong as it may seem, especially with the Dow Jones Industrial Average. We still have a lot of work there to do, and I wanted to focus on a Dow-related stock for our trade application example at the end of tonight's video to set up for a possible bearish rollover event. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 22nd, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and while you're over there, make sure you sign up for our email distribution list, which you'll find down below in our description area. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see listed in the logo in front of you. All right, let's go ahead and jump into today's trading activity. And as I mentioned in the intro, S&P 500 was just shy of hitting a new high. You can see kind of where we closed. We did close in the upper half of today's range. It wasn't directly at the top. You can see there's a little bit of a shadow up at the top of that candle, but nonetheless, good to see us close near the highs of the day. And in doing so, just a stone's throw away from hitting that new record high there on the S&P 500. Now, having said that, you can see here that the background color of the chart remains pink, and the reason for that is the green line is continuing to fall despite the back-to-back winning sessions that we've seen here. You have to keep in mind that we had 4 down sessions in a row prior to this back-to-back winning streak that we've been on the last couple of days. So with the intermediate line going back and analyzing the most amount of data, at least in comparison to the blue near-term line and the red momentum line, a 2-day rally isn't necessarily going to swing the posture back into a bullish mode. If we're up another couple days, I think it will, especially if we get up and over that all-time high. I think we'll be back to a bullish posture pretty easily if that occurs. Now, we don't know if that'll occur because we're basically sitting right at resistance there with the S&P 500. You'll see that we were very close, in fact, to having an overbought cluster signal here today. Weren't quite on that because, again, the green line did fall just a touch below 80. Remember, it would have to be above 80 to technically qualify for that, but we're right there. So kind of the mindset of the cluster would be up at that level there. So we might have a little bit of an overbought condition in that particular index. Now, off to the right-hand side here, this is the chart that is a little bit more worrisome. This is the Dow Jones Industrial Average. It closed higher today as well. It was up 0.2%, but you can see that we've still got a lot of work to do on the right-hand side of this chart. This is still that dark pink shading as opposed to the light pink you saw over here with the S&P 500. So this dark pink shading suggests that we don't just have a bearish posture, it's a strongly bearish posture. And that occurs when that green intermediate line falls below that indicator's 50th percentile. And so we've been there for the last 2 or 3 sessions at this point. And you'll notice that it looks different in another way from the other charts as well, and that is the moving average is red. Remember, what that indicates is price is below a falling 30-day moving average. With our other 3 indices here, you can see price is above a rising moving average in those cases. So it's been really interesting, and I don't know if you guys have noticed this as well, but it's felt like this market, I think I might have mentioned this actually last week, come to think of it, but it's felt like the market has been passing the baton, for those of you that were ever in track and field, if you're ever on a relay race, passing the baton from one index to the other. And I did hear a stat somewhere along the way, might have been a podcast, where they were saying that the difference between the S&P 500 and, let's say, the NASDAQ composite is more extreme here in the last several months than it typically is. Usually you do not get like 1% differences between them, and we don't have that today, but the point of the stat that I was listening to was that we've seen a lot of that kind of action here in recent months, and for a long time it was the S&P 500 up, NASDAQ down, and now we're seeing that kind of flip around a little bit. And so it's been really interesting to see, that baton being passed from, the Russell 2000 to the Dow Jones to the S&P 500, and now it's kind of the NASDAQ composite that is taking that baton into the finish line. You can see down below here that the NASDAQ composite actually hit a new all-time high. Remember, we've been waiting for that. Last week we got oh so close. We were talking about how the Qs, the QQQ ETF that tracks the NASDAQ 100, in other words, the largest companies on the NASDAQ composite that are non-financial, that had already hit a high last week. The composite itself, the bigger index that composes hundreds if not thousands of stocks, has not hit a new high. Well, that changed today. We finally broke up and through that, and a pretty clean close there as well, right? We closed near the high of the session. Sometimes you get these whimpers as you have a breakout. You have a breakout to the upside, and then you immediately force people who played that breakout to regret it. That did not happen in this case. So I think that bodes well for the NASDAQ composite. Some of you that follow me on Twitter might have seen me posting about Microsoft earlier today. Microsoft is just one of several big tech names that is either at a new all-time high or at least very close to it. And so, Microsoft had kind of been left alone for a while, and we hadn't really been talking a lot about it, but all of a sudden it seems like it's off and running right now, and that's, of course, highly supportive of the NASDAQ composite itself. Now, you'll notice that things have gotten so strong with the NASDAQ composite, which was our leading index today, by the way. We were up 0.79% on the NASDAQ composite. Notice we've got this little red dot showing up down below. That's kind of what I was referencing before with the S&P 500, where we almost got the cluster. Here we officially did on the NASDAQ composite. So that red dot will appear when the green, the red, and the blue line all close above the 80th percentile on the same day. Now, just because that's showing up doesn't necessarily mean that we're going to have some sort of a reversal of fortune. I think David has done a great job working with you guys on that concept in the past, where if you have one of these overbought cluster signals early on in the move, it can actually be viewed as a bullish thing. It's basically saying markets are just revving up in a big way right now, as opposed to seeing that at the end of a move. That's a different type of a story where if the markets have been rallying for months and months and months, and then you get one of those, then it's kind of, maybe gives you the perspective that you're going to end up having kind of the last breath. That's the last kind of oomph towards the finish line. The NASDAQ doesn't really give us that impression at this moment in time, right? The NASDAQ has been languishing compared to some of these other indices. NASDAQ had been just chopping sideways. Today is the breakout day. So you're having a breakout to a new all-time high that we've been waiting for quite some time, and it happens to also be a day when you're getting that cluster. So we might have a little bit of room to run on the NASDAQ here. Now keep in mind, the NASDAQ is chock full of a lot of growth-oriented names, and they are interest rate sensitive. A lot of people don't understand that or make that connection initially. They understand the connection of utilities and utilities and real estate being interest rate sensitive, but they don't really get the concept of the growth stocks kind of representing kind of the same type of a concept there. And it's all about the discounting cash flow mechanism, the farther that interest rates fall, the greater the chance is for your cash flows to benefit you in the near term from those types of companies. Whereas if the interest rates are to rise in the future, then you oftentimes see things like the financials, kind of big lumbering giants like JP Morgan and Wells Fargo and things like that doing a little bit better. So we've seen interest rates falling. That has been supportive of technology, real estate, and then a little bit of utilities, although I must say utilities haven't really been giving us a whole lot of excitement. But we have seen some legitimate moves out of technology and real estate, and we'll talk about that here a little bit later when we look at the sector selector. And then just real briefly here on the Russell 2000, remember this is the small cap index. And by the way, I know not all of you are premium members, so you might not have caught my Telegram alert about the small caps, but we actually got bailed out last week. I kind of pushed that trade to the very end, but our bearish trade on IWM did expire worthless. Remember, we had done a bear call spread on that, and so it was no longer in the money by the end of the week. Now, we needed a 5-day pullback in order for that to occur, but the interesting thing about that is that's the second straight time that's happened. It should probably teach me to be a little bit more cautious if I ever have an interest in taking a bearish trade on the Russell 2000. Yes, both of them have worked out at max gains for us, but we really had to earn it. It didn't feel good during nearly the entire life of the trade, and we kind of got bailed out right at the end on both of those. So anyway, kind of interesting to see how that shook out last week. But here this week, so Monday, and then here today on Tuesday, we've seen a nice little rally. Now keep in mind, we still have that background color being light pink there, similar to the S&P 500. You saw both of them close below their moving averages on Friday, and then Monday, Tuesday, jump back above it. They're both kind of in that same kind of setup right there. One of the differences being that the S&P 500 does seem a bit stronger here than the Russell 2000. Notice that the Russell 2000's candle, you're getting a nice bounce off the moving average. We like to see that, but notice that we are quite a long ways away from that high that was set there on June 9th. So of the two, I think I would still prefer the S&P 500. And again, that makes sense. A stock like Microsoft is going to have an impact on the S&P 500, whereas it's not part of the Russell 2000. Keep in mind that the Russell 2000 and all the Russell indices will be going through a major upheaval later on this week. It's usually mid to late June when there's a big rebalancing that takes place. So you might see some artificial volume coming into the indices later on this week. So be on the lookout for that possibility there as well. So to kind of wrap things up, we've got a bit of a crazy market. We've got one strongly bullish stock or index, and that's the NASDAQ composite. We have one strongly bearish index, and that's the Dow Jones Industrial Average. Then we have two weekly bearish indices, which is the S&P 500 and the Russell 2000. But in the case of the S&P 500, we're very close to all-time highs, and so we could easily revert back to weekly bullish or even strongly bullish as soon as tomorrow or the next day if we get a little bit of extra upside from bullish activity here. So again, it's not very normal. For those of you that are newer to these videos, what we see here is not very normal in terms of the rotation this quickly on an index level. We see rotation from a sector perspective quite often. That is not all that surprising. But to see it from an index to index to index perspective is a little bit odd because a lot of times these things are highly correlated to one another. If stocks are up, they're all kind of going up together. Stocks are down, they're all kind of going down together. Well, that is not described what we have encountered here in the last few months. So it's been a more interesting time to be paying attention to the market and to be trying to go after good trade setups, which I hope you found through some of David and I's videos here. Let's go ahead and take a look here at our next chart, which will be our 3 green arrows chart. This will be chart 4D. As we pull this up here, it's kind of the same concept that I just mentioned a moment ago. Crazy market, because in the case of the NASDAQ composite, we have a 3 green arrows signal. In the case of the Dow Jones Industrial Average, we have a 3 red arrows signal. And then in the case of the S&P 500 and the Russell 2000, we have a mix of green and red arrows. Remember, if the background color of chart 4D is white, like it is right here, and like it is right here, it means there's a mix of green arrows. With the S&P 500, we've got green arrows on the moving average, and we've got a phantom green arrow as of today on the stochastics, but we still have that red arrow in play there on the MACD histogram. And with the Russell 2000, here's another good way to kind of make that determination that I mentioned a moment ago, that of the two, it appears that the S&P 500 is slightly stronger than the Russell 2000, because here you can see you've got 2 red arrows and only 1 green arrow. We do not have a phantom green arrow setting in place there on the stochastics yet, like we do as of today on the S&P 500. So if you're kind of ordering these, it is clearly the NASDAQ composite that's leading this market right now, followed up not too far behind by the S&P 500. Now remember, the S&P 500 is a market cap weighted index. and it's led these days by big tech, right? The Microsofts and the Apples of the world, and some of the Facebooks and Alphabets and all those. You're going to have lots of those types of exposure in both of those indices right now, and that wasn't always the case, right? Two decades ago, tech was not all that important piece of the S&P 500, or at least not nearly as important as it is today. Today, most of the top 5 to 10 stocks in the S&P 500 are technology related. They might not all be in the actual technology sector, but some, like an Amazon, are kind of thought of as digital or e-commerce plays or cloud computing, even though technically it's in the discretionary area. So the indices have changed a lot over the years, and you're kind of in an era right now where the NASDAQ Composite and the S&P 500 are a little bit more closely aligned than they have been in previous years and decades. In the past, it was probably a little bit more closely aligned. The S&P 500 and the Dow Jones were a little bit more closely aligned, but today it almost seems like the S&P 500 and the NASDAQ are more closely aligned, because the big market cap winners of the last decade have come from the NASDAQ Composite. And remember, there can be overlap there. I mean, I know some people who might be new might be curious about that. Are some stocks in multiple indices? And the answer is absolutely. A stock like Apple is actually in 3 of these indices. It's in the Dow Jones Industrial Average, it's in the S&P 500, and it's in the NASDAQ Composite. Now, Apple's not in the small cap Russell 2000, but the point is you can have some blending and some overlap. And so right now, I think we've got a lot of blending and overlap with the S&P 500 and the NASDAQ Composite, and those are the 2 areas that seem to be wanting to lead this market at this exact moment in time. I'll also add that it's impressive to see so far. Now, the week is young. We're only 2 days into this, but so far we've had 2 up days for the market. And according to my handy-dandy Stock Trader's Almanac that I have on my desk here, it says that the week after the June triple witching, which, remember, that occurred on Friday, the Dow is down 27 of the last 31 years. So that is pretty damning. So even the Dow, while it hasn't been leading the last couple of days, is up both of those days. So the fact that it's got this head start, winning the first 2 days, it would have to fall quite a bit in the ensuing 3 days to kind of keep up some of those statistics there. So usually this is a pretty bearish week for the markets, and right now we're not seeing that. So some people might have been caught a little bit flat-footed in this market, assuming that historical seasonalities would hold. Maybe they're sitting this week out, and so far maybe that's been the wrong decision, right? You've seen some pretty robust gains across the board. All right, let's go ahead and pop on over to the internet briefly. I always like to get a chance to say thank you to those of you that help support this project. I'm always shooting to get triple-digit likes, and you guys came through for me once again. I really appreciate that. 102 of you clicked like there for me on Twitter. Keep up the great work. As long as we're getting some strong encouragement and participation and involvement in social media, then that's our motivation to keep on doing these free videos, right? Some of you might think, well, don't you just love teaching so much that this is, what is your passion? And that is true, but keep in mind, David and I are teaching all day anyway to our paid members, our premium members. We don't need to, keep on teaching to, a free YouTube audience. So we do that partly as a promotional, and then also partly as educational. And so as long as you guys can keep up your end of the bargain, help promote us here and there. We don't charge anything to listen to these YouTube videos. That'll help go a long way for us to be motivated to continue to do these videos as often as we can. So thank you to those of you that help us along with that. Also, earlier today I taught my dividend growth investing class. And you're welcome to check out that video if you're a premium or a plus member. We concentrated on the materials space, and that does complete our 11th out of 11 sectors for this current iteration of the portfolio that I'm putting together for dividend growth investing. It was a close call. We almost nearly didn't have materials, but we had enough of a pullback last week where there were a couple of materials companies that kind of fell into our value territory that we're seeking out in that particular class. And then David taught his directional options strategies class earlier today as well, so make sure you're checking that out once he posts that video. Tomorrow morning I've got my factor-based swing trading class at 11 a.m. Eastern time, and then he's got his inventory trading class there at 2 p.m. Eastern time. So lots of great content coming your way if you're a premium or a plus member. Also, I did notice that the TrueCar trade worked out very nicely there. Excellent bounce the last couple of days off that rising moving average. So congrats to those of you who took that particular trade to it. Looked like it went right up to the penny to our price target here today on TrueCar. Also, while we're over here, let's take a quick peek on Sector Selector. And remember, I put this together on the weekends. And it usually is going to be put together somewhere around, let's call it, I don't know, 7 to 9 p.m. Eastern time on Friday nights. Last Friday night was a little bit different because a lot of my scans and things that I used to collect the data for this were not working. Thinkorswim must have been doing some updates on Friday night. So got out a little bit later than normal in terms of some of the tools, but at least gives us a good idea as to what sorts of rotations we're seeing out there from a sector perspective. And you can see that energy was able to hold on to the top slot, but their lead is getting slimmer and slimmer by the week. Energy stocks had not been rallying very strongly last week, but because they had such a head start and were doing so well earlier in the year, it kind of bought them some time up there at the top. On the other hand, real estate has been showing some excellent strength here more recently. You can see that real estate has advanced for 3 or 4 straight weeks. They're now ranked number 2. Remember what I was mentioning before about that interest rate sensitivity. I think that's really helping those REITs right now where they're breaking to new highs in many cases. But REITs were kind of stuck here in the middle of the grouping, this purple ball from April 23rd through, actually it was May 28th. They were stuck in the 7th place position. Then they had that big jump from 7 up to 4. And then each of the last few weeks, we've been rallying one more slot. So who knows? Maybe we get real estate up at the top of the heap one of these weeks. Now remember, the same things that benefit real estate with their interest rate sensitivity are a disadvantage to financials, like the banks that are out there. And so you did see some slippage there in the financials. That number 3 position right there is the worst position that the financials have been in since going back here to the first week of April. And then also technology was really impressive, just like real estate has been. Technology was stuck down here in the 8th place position for a long, long time. And remember, that was during a time when interest rates were largely rising, but we've seen interest rates really start tumbling here in recent weeks, and that has given some new life to a lot of those growth stocks. And so a lot of those growth stocks belong to the information technology sector, and you now find them in the top 4. In fact, that was the area we concentrated on in my Monday top-down trend trading class, where we did analyze 3 different software names that were performing quite well and breaking out with some nice relative strength. So if you're interested in that conversation about software, that would be Monday's recording for top-down trend trading. We did see materials tumble in a big way, and I think the story behind that move with materials is, remember what I was mentioning last week in these videos, and I'm sure David was bringing it up as well in his. The U.S. dollar was surging last week. I mean, it was a little bit shocking. We usually don't see the U.S. dollar move as aggressively as it did last week. Remember that the materials area is quite sensitive when it comes to currency movements, and typically when the U.S. dollar is strong, materials struggle on a relative basis, and we certainly saw that last week. That was a pretty ugly drop from number 4 all the way down to number 9 there. A lot of the mining companies, we actually kicked one of the mining companies out of our top-down trend trading portfolio on Monday. But there's other areas within materials like chemicals and some of these other areas that are starting to get beat up a little bit more so here recently. Now, the good news is materials are a really small sector in the grand scheme of things. And so they don't have really the ability to take the whole stock market down with them. But if you do have some exposure to materials, you probably felt a little bit of pain last week. I know we certainly did with the ones that we hold in that top-down trend trading class there. But on the other hand, it did open up that opportunity, like I mentioned to you a moment ago, to actually talk about the materials in my dividend growth investing class today. Remember, we kind of have the opposite mindset there, where when stocks or sectors fall, we actually become more interested in those areas because all else being equal, their dividend yields are becoming more attractive as they fall. So, yes, it's unfortunate that a lot of the materials no longer have solid trends, but for those of you that have been waiting in the wings looking for dividend growth investments, maybe you're about to embark upon an opportunity here if they continue to languish. All right, let's get back on over here to the Thinkorswim charts, and let's do some 12 grid analysis. So we'll start off with chart 5A. This will be our asset class 12 grid. And one of the bigger stories today was Bitcoin. That's the chart off to the right-hand side. It actually cracked below 30,000 at one point today. Now you can see where it stands right now. It's just above 32,000. But that was one thing that I was tweeting about a few weeks ago. I was saying that it looks like it's destiny for Bitcoin to break below 30,000. It didn't happen right away, but eventually that did prove to be true as of this morning. Now, the interesting part about that is there wasn't any sort of crescendo selling that was taking place after it did gut through that $30,000 level. Instead, you actually had buyers step in. So who knows? Maybe you had a big group of people out there that said, if Bitcoin can ever get back down to 30,000 again, I'll start nibbling just a little bit. And so you had a pretty impressive rally at the end of the day. You'll see that candle right there looks pretty good. I mean, it's not quite as strong as that long lower shadow we had back there, but all else being equal, that is a rather enticing candle right there. But we'll see if it can represent kind of a hammer if it can go up tomorrow. Remember that these one candlestick patterns do need confirmation the follow-up day. So we'll keep our eyes on that. Right now, the trend still looks horrible, but you might have a little bit of an opportunity to get back up to that falling moving average here if today's intraday activity was anything to sink our teeth into. Now, part of the news behind that is China has really been, trying to push cryptocurrency out in a way. And so that a lot of the news headlines, the negative news headlines have been around China. There's been a little bit around El Salvador as well, but I think China is really the one that is putting fear into the marketplace because China is, of course, a massive financial prize. And if they are just wholesale saying, we don't want that Bitcoin in our country, then of course that's going to pose some risk to those who had really ambitious price targets. Like, there's people out there that think Bitcoin's going to 100,000 or 200,000 or what have you. And, if certain countries are just going to not allow the usage of it, it's possible that, some of those price targets need to be pulled in just a little bit. Other things that were interesting in the market today, we did have interest rates falling again. So interest rates fell down to 1.47%. And so you can see we've been in this steady downtrend in interest rates. So that is part of the reason that technology and real estate has been able to improve their prospects during this period of time that we see right here. You can see that the US dollar was down today, but not a whole lot, right? The US dollar after last week, it's probably just taking a little bit of breather. I mean, this was an epic two-day rally that the US dollar had here on the 16th and the 17th. The last 3 days, it's just been kind of languishing, going down just a touch, but still hasn't even come down to that initial candle there. It's kind of come down to the bottom of that second day rally right there. But even that, remember, that started with a gap. So if you really want to think about where the low would have been, it would have been at the top of this prior candle. But it gapped up to start the day. So we've got probably a little bit of support right at the level that we're sitting right there at the US dollar. We'll see where that takes us. Today, you did see oil up in the face of a falling dollar. Oil was up 0.12%. Nice, steady uptrend there with USO. As you can see, we did have a new multi-month high there in oil. Gold, unfortunately, did not have the same enthusiasm. You saw gold actually fall 0.42%. You can see how different those two charts look. And again, kind of going back to the sector selector that we reviewed a moment ago, remember how energy was number 1 and materials fell all the way down to like number 8. Remember, that kind of explains what's happening at that core commodity level as well. Energy, of course, is closely linked to oil, and materials are closely linked to gold. Gold miners are part of that materials sector. And so these charts right here probably explain a lot of those movements. And right now it seems that of the two, if you're going to be hanging out in the commodities world, it seems like the oil world is the place to be. In terms of other charts that are out there, one thing I would point out is that it looks like EFA is looking a little bit dangerous here. Now this is a little bit odd because it might have been about 2-3 weeks ago or so. I was mentioning how I liked the way that EFA was performing. And it just goes to show you that these charts can change awfully quickly. And as I look at it now, all of a sudden, I'm much more concerned about EFA. Now, of course, I didn't know the US dollar was going to absolutely erupt along the way. And of course, when the US dollar goes up, all else being equal, foreign securities go down on a relative basis. So I think that's a big part of the story there. But nonetheless, we want to keep our eye on that, because right now I would say that the dollar has a pretty decent chance that if it does sell off in coming days, it will likely catch a rebound before breaching this moving average. Likewise, you might find a rally in EFA. It was up today, just barely, but it was up. But it could very well stall out just under its now falling 30-day moving average. So that's a bit of an update there. Unfortunately, EFA and the foreign developed stocks do not look nearly as enticing from a trend perspective as they did just a few weeks ago. Foreign emerging stocks don't look all that much better either. You can see that they're also trading below their falling moving average. It's just that their chart was a little bit different before that, because you can see that EFA had a long uptrend in place. Even after this drop that we've had in the last couple of weeks, EFA is still up 4% over the last 3 months. Whereas you can see EEM isn't even up 1% over the last 3 months. So it's been more of a sideways chop here over a longer period of time. But both of them did end up doing very poorly when the US dollar was rallying like we saw here more recently. Also, I would point out that preferred stocks and high yield bonds look kind of interesting all of a sudden. Remember, they tend to benefit when interest rates fall, all else being equal. So you're kind of in that environment where preferred stocks and high yield bonds can work for you. They don't have to, but high yield bonds, particularly when you have falling interest rates and rising oil prices, because remember, it's still a lot of those oil companies that are issuing those high yield bonds. So there is a close alignment there still. So this is kind of one of those better environments to be involved in high yield bonds. When oil prices are rising and interest rates are falling. It's supportive on a couple of different levels there. Preferred stocks, keep in mind, a lot of those are financial oriented stocks that are issuing the preferreds, but they kind of act more like bonds than they do like stocks in many cases. And I think that's kind of what's benefiting this chart right now. But you did have a nice breakout there in PFF today in the preferred stocks. We don't talk a lot about that, but for those of you that keep your eye on it, today appeared to be your breakout day, and you did close basically at the high of the session. So a nice clean breakout there on preferred stocks. Let's take a look here at our sectors now, and this will be chart 5C. As this gets pulled up here, you can see we still have a lot of red on the chart. So I'm not an enthusiastic supporter of the market at this exact moment in time. Don't get me wrong, I'm happy that the markets have gone up the last couple of days, but I think there has been quite a bit of wear and tear on the charts. And so I just want to be a little bit more cautious and hesitant, I think, in this environment. There are certain areas that are working really nicely, right? Technology has come out and is just, making a move like you wouldn't believe here. Take a look at technology basically closing on the highs of the session and getting that overbought cluster signal there kind of early in that breakout mode from that previous kind of double top that we had back here in April. So great move there in technology. They are definitely one of the leaders of this market right now. But there's a lot of other areas that look much more concerning. In particular, these two charts in the middle, and I would also throw in financials into that mix. I do not like what I see out of those charts. Those are some pretty ugly breakdowns that we've seen in financials, industrials, and materials here just in the last 2 or 3 weeks. Remember, usually those moves are going to be a little bit more gradual. These have been pretty shocking and violent to the downside. I mean, look at financials on that day. That was, that was pretty aggressive there, right? That might have been the day after the Fed announcement last week. But those charts have changed for the worse. There's no denying that. You can see that these charts, after being in steady uptrends, now have red moving averages telling us prices below falling moving averages. And so all else being equal, my assumption when we have charts like that is if we get a rally, you're going to start seeing some resistance bounce back down until you kind of work that out. So it's a little bit of a challenge there. Now you still have kind of that same behavior down below with the staples and the utilities as well. It's just I'm not overly concerned about them because they're not they're not market moving the way that financials and industrials are. Materials really aren't either. It's unfortunate that materials broke down because they were kind of a leadership group previous to this. Remember, staples and utilities have not been a leadership group for many, many months. So the fact that they're still languishing isn't really affecting my mindset. It's a little bit more of a shock and awe for what we're seeing there out of the materials. So, as you look at these charts, there's still a lot to be desired there. With communications, you have that white background, supposedly because the intermediate line was flat here today, so that can happen there. But that chart looks pretty good as well. You have a nice 2-day bounce there. Remember, a lot of the communications overlap nicely with technology. Your Facebooks and your Alphabets of the world are part of the communications, and so they tend to move in unison with things like Apple and Microsoft that are part of technology. So good to see both of those off and running because those are good areas to look for trends. And so I do like those two charts, but a lot of these other charts are looking, a little bit nerve-wracking all of a sudden. Let's go ahead and get into our trade application example now. And for that, I'm going to get into chart 3A. This will be the swing trading chart. Remember, I teach my swing trading class on Wednesday morning, so I'll see many of you in that class tomorrow. But the stock I wanted to look at was Merck. I mentioned that the Dow Jones Industrial Average is really struggling, so I wanted to kind of pick on a Dow Jones Industrial type of a stock, and there were actually a lot of them. I could have gone a number of different directions. Disney does not look all that good. Home Depot does not look all that good. Intel does not look all that good. So there were a number of them I could have picked on. Ended up going with Merck here, just simply because we were kind of rolling over at the falling moving average. And I kind of like those setups where, you had this big drop from basically 80 down here to 72 in about 2 weeks. Then you had this reversion to the mean type of a bounce here. It actually started to gain a little bit of steam along that moving average. It kind of hung out there a little bit more. This thing could have failed immediately on that candle and kept on going back down, but it actually kind of hung in there a little bit better. So I'll give it credit for that. But it hasn't been able to tack on any more progress after that. The stock has just been stuck going sideways. Now all of a sudden we see ourselves down and trading below a falling moving average. You'll notice that the background color of this chart is pink, telling us that this blue line is giving us a bearish posture right now. The green line is slightly bullish, but it's kind of stuck in the middle range there as well. It's not really giving us a whole lot of momentum. It's just kind of stuck in no man's land. But we do have a bearish near-term posture at this moment in time, and you can kind of see what that rollover looks like there, where you might have a close below the low of the high day. If you were to look at this as kind of your high day more recently in this recent move, you can see the high on an intraday basis was up here on this candle, and you did close below the low of that candle, just barely today. You didn't close below the low of the follow-up candle, but that wasn't the high candle because technically that intraday candle did not go higher than that previous one. So a little bit of a funky pattern there, but I think you get the gist of it where you have some resistance where this stock just feels heavy here. It feels like it's really struggling at this level. And keep in mind, the market was up today, right? It was a good day for the stock market. And Merck, which generally you would assume just kind of does whatever the market does because it's a big lumbering giant, well, it was down 0.73% today. So not a good look for Merck there. And you can see that it's woefully underperforming the S&P 500 over the last 3 months. And also has a bit of a bearish near-term divergence signal where we have kind of this high candle right here. So we have peak number 1 right here associated with this candle, and then we have peak number 2 associated with this candle. So in other words, we saw prices progress even though the underlying indicator was suggesting some bearishness underneath the surface that most people that just pay attention to price aren't recognizing. So that could also be helpful in this particular trade. Now, the trade that I did was a put spread. Now, this was a long put spread, so not a short put spread, a long put spread, which means I'm bearish on this trade. And I think the strikes that I did were the 77.50 and the 75. We usually do the bought strike and the sold strike kind of straddling where the stock is trading right now. So we buy one that's in the money and sell one that's out of the money. So, and I think I did it for the July time period there. You can always check the Telegram. Remember, I've already done this trade. The trade's already been executed during the market session. So that's one of the benefits you premium members receive is you get alerted anytime David and I are placing trades for our various portfolios. So trade's already been done, but what we hope to accomplish with this trade is for this stock to continue to go lower. Now remember, unlike a credit spread, this is a debit spread and it is more directional in nature. We do require this stock to actually fall. If it were just to go sideways, that's not good enough in this particular case. We need the stock to actually fall in order for us to make money. That's the bad news. The good news is we can make a lot more money than what we typically make on a credit spread. In this particular case, I have the ability to make about 100% return on my risk, whereas with most of our credit spreads, we're usually looking at around a 30% return on risk. So there's always those trade-offs that you have to consider. And I just figured, you know what, we've got some other bullish trades in our portfolio right now. Probably be good to have a few more bearish ones from time to time when you see the setups, and this one seemed like it was as good as any out there. And so we'll give that a shot and see how that moves forward for us in the coming month or so, based upon that bearish near-term divergence and the stock bouncing down and away from that falling 30-day moving average. So that's what I had for you here tonight. I appreciate you checking out the video. If you got value out of the video tonight, I ask one and only one thing out of you. Just simply click like for me there on Twitter, and you can do that in kind of 4 different places. You can do it either if you're on Twitter itself, and usually I have these pinned to the top of my timeline, so you can just go over to my profile and you'll find it there. Otherwise, you can actually click the heart button within the Twitter widget underneath the video that you might be watching on our website right now. We also put the link to the tweet in the email that we send you guys that are on our distribution list, and it's also in the description area of the YouTube video that some of you might be watching if you're directly on YouTube right now. So 4 different ways for you to help support us there on Twitter, and we appreciate each and every one of you for doing that. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.